Buenas tardes a todos. Good afternoon, everybody. It's a pleasure to be part of this panel, the ColCapital event. So right now we will be talking about secondaries in many different aspects. Here we have a very strong panel for participants. So maybe to get started, I would like each one of you to make a brief introduction on yourself and the firm. And then if you want, we can start with the questions and answers. So let's start with you, Derek. Can you make an introduction, please?
Sure, Francisco. Thank you, and thank you to the ColCapital, and wonderful to be with everyone this afternoon. I'm Derek Snyder. I'm a managing director and partner with Altamar Capital. We're a $9 billion AUM private markets investor with offices in Madrid, New York, Santiago de Chile, and Barcelona. We have a diversified approach to private markets investing. We invest in private equity, private credit, real estate infrastructure, and venture capital. When it comes to secondaries, we've been investors in the space for about 15 years, and our strategy is more focused on the lower end of the market, and in particular in GP-led liquidity solutions, which I'm sure we'll talk about a little bit today. We believe that's a really interesting and attractive end of the market. So I'm looking forward to an informative and dynamic session with my fellow panelists today, and thanks again for having me.
Thank you so much, Derek. Renato?
Hey everyone, good afternoon. It's a pleasure to be here. My name is Renato Weiss. I'm a principal at Lexington Partners. Lexington is an independent secondary and co-investment private equity firm. The firm has been was founded in 1994. Today we have about $40 billion AUM. We are currently investing out of our secondary fund number 9. It's a $14 billion fund. We also have a middle market strategy and a co-investment fund. We have only 2 strategies, secondaries and co-investments. We also have a global presence. So in Latin America, we have an office in Chile and Santiago and one in São Paulo, recently opened. 3 offices in the US, New York, Boston, and California, one in London, Luxembourg, and Hong Kong.
Good. Thank you so much, Renato. Rudy?
Thanks, Francisco. I'm Rudy Scarpa. I'm a global co-head of Pantheon Secondaries business. I've been with the firm for about 14 years and located in New York. Pantheon is a $50 billion asset manager with global offices, including a strong presence in Latin America. We have a co-invest business, infrastructure, credit business, and of course, a large secondaries business. We've been doing secondaries for over 35 years and have about $9 billion in that strategy. And our platform as a whole is very strong. We've got about investments in about 2,000 different private equity funds. We sit on about 500 advisory boards.
Thank you so much, Rudy. Jeff?
Great, thank you, Francisco. My name is Jeff Keay. I'm a managing director at HarbourVest Partners, and I help oversee our global secondary business. I've been with HarbourVest for a little over 20 years. We are a 70+ billion AUM business that began in the early 1980s. We invest into private equity across primaries, secondaries, and co-investments, and specifically invest into private equity, private credit, and real assets. We also are independent and have 10 global offices from which we attack the overall private equity markets, including in our secondary strategy, and we're currently investing out of our 10th Dover Street Fund.
Okay, thank you, Jeff, and everybody else. So now let's get started. I guess the most obvious question would be, and this one will go for you, Derek, is what is your assessment of the industry, the secondary industry right now? I would like to say post-COVID, but I would guess it's actually through COVID. Any lessons learned or general comments that you can share with the audience?
Yeah, look, it's a great time to be asking the question. I'm sure everyone has a perspective on this, and let me just begin by sharing ours. I think, fundamentally, we look at the secondaries market as being relatively time. Things have changed, markets changed, and buyers in particular have adapted. Clearly, what we're seeing today as we come out of COVID is a bit of a change in the type of transactions we're seeing. I think, traditional transactions, which are usually a trade between a buyer and seller with an approval of a GP. And today we've seen enormous growth in the GP-led end of the market, which, like I said, we'll talk about a little bit in a bit more detail as we get into these questions. But that was an end of the market that 8 to 10 years ago was a real fraction of the size of the space, and I think at the end of 2020 was roughly half of the market. And I think we can ask it given their pipelines, but it's probably going to be about half the market for 2021 as well. Our view is this GP-led trend is here to stay. I think GPs like these deals. They end up being a good LP cleanup exercise. Gives them flexibility to hold assets a little bit longer to capture more value. And I think the sort of the modern function and structure that we're seeing in these transactions is also attractive enough to LPs that are existing in these portfolios. They have usually the optionality to either roll or potentially sell. So it seems to create a solution for a lot of the parties here. I think in general, post-COVID, we think it's a really interesting time for secondaries. I'm sure everyone here will echo that sentiment. There's a really great pipeline that we have today. I'd say it's better than any pipeline we've seen in the past. And in particular, focusing on the lower market, and we think it's a really fertile space for doing GP-leds. I mean, that was these deals that had really sort of begun on the larger end of the market initially, and are just sort of starting to scratch the surface of the lower market in private equity. So we think, to conclude, I think it's a really interesting time to be in secondaries. I think there are a lot of great opportunities out there.
Excellent. Thank you so much, Derek. Now, Jeff, if I may try to get your comments on this particular aspect of, I don't know if it would be, lessons learned, but again, how are you adapting to this new reality, going from these Zoom meetings all day long to thinking differently on how should you value underlying portfolios, preferences for industries and sectors? I know what we used to call defensive might not be as defensive as we thought that was the case. So if you can comment on that, we would appreciate it.
Sure. So look, I would say overall, and Derek used the word adaptive, I'd say another word that comes to mind is just resilient in how much the secondary market was able to bounce back from the lack of visibility and the chaos and uncertainty that unfolded toward the end of the first quarter of this year, at least in some of the more developed markets when COVID was at its worst. And I think most of us very quickly moved to working in a remote environment. And I think what's been most remarkable is frankly how little has changed in terms of how we approach how we do our jobs and how we evaluate assets in a remote environment. We really have not seen much in the way of changes to how we practice what we do. The real impact, of course, was on how we screen opportunities and the types of assets that have been of greater interest in this environment, just given the uneven impact that COVID has had on a variety of interests in a variety of industries. And that's been, I think, one of the big differences between, for example, what we experienced coming out of the global financial crisis versus what we've experienced in a COVID environment, where there have been certain industries that have been decimated by COVID. And you think about travel and leisure and all of the industries that have been impacted most acutely. And then you compare that to other industries that have either been impacted very little, and then there's COVID has been a benefit to them in terms of the tailwinds that that's created from a growth and revenue standpoint. So I think our approach in COVID and many players have been to really focus on those opportunities where there's greater visibility, lower levels of risk, just given how various industries are responding to the dynamics of a COVID environment. And that's really informed our view on where we spend our time. The other point I'd make is we've probably assigned more value to partnering with those underlying sponsors that have had a greater depth of experience in navigating difficult environments. General partners that have managed portfolios through more challenging environments and have had to take tougher decisions and been rewarded for those decisions. We have found that those general partners have particularly performed well in a COVID environment. And so in general, I think there's been greater recognition that there's particular value in having those types of partners in secondary transactions, just given the benefits that come with the experience of investing across economic and private equity cycles.
And so I would like to go with you, Rudy, as we think about being adaptive, but at the same time, how the business and how you analyze transactions is pretty much the same. And all this pandemic for GPs and LPs, particularly nowadays, and giving the market conditions that we're experiencing right now.
Sure. And if you take there's two transactions, right? When you think about secondary deals, there's the traditional LP deal where you're basically selling an LP interest. And as Derek said, you've got the GP-led deals. Those are deals with the general partners much more actively involved in a liquidity solution for their limited partners. So on the traditional LP side, when a private equity LP interest is being sold, the benefits for a limited partner in general is to take an asset that was otherwise illiquid, because it's an illiquid limited partnership interest in a private equity fund that owns private companies, and be able to sell that in the secondary market. So they're unlocking value there because they're able to now access the secondary market and sell what was an otherwise illiquid asset. And that became particularly relevant during COVID because, and this just lasted for a short period of time, but there was what we called at the time a liquidity effect. Because the underlying private companies couldn't find exits. There weren't IPOs, there weren't strategic sales, and so on. And so the limited partners in these private equity funds were not generating much liquidity, as much as they expected. And so they needed to access the secondary market, and it was there for them to be able to buy those limited partnership interests. So from an LP perspective, the benefit is being able to sell an otherwise illiquid asset, particularly during times like there was, from a general partner's perspective, in a traditional deal, in a traditional LP sale, you have, a limited partner that may not be supporting you going forward, and they choose to sell their limited partnership interest. From a GP's perspective, that's helpful. There used to be a stigma years and years ago when I started in the business where LPs, limited partners, didn't want to sell their interest because they thought it looked bad with the general partners. But now general partners would prefer that limited partner actually transfer their interest to a buyer, to another institutional investor that could support their platform in the future, namely by providing them with primary capital. So these secondary transactions can be win-wins for the sellers. They could be a win-win for the buyers, like ourselves, and also for the general partners. And then you have the general partner-led transactions that Derek started talking about, and these again are transactions where the GP's involved. They may either do a tender offer or sell their entire portfolio to a secondary buyer, or sell a couple companies from their portfolio, or one company from their portfolio to a secondary buyer, artificially generating liquidity, accelerating that liquidity. And for those types of transactions, you do have the institutional investors in those funds generating liquidity, which is good for them. You have the general partners benefit to give their LPs liquidity in a fund that may be old, and you've got fatigued LPs, but those general partners may also be able to reset their economics on those assets. So when those assets are sold to a new buyer, they basically get new management fees and reset carry and so on. And they may even be able to ask for a staple or primary investment from the new buyer. And then as a buyer, the last constituent in that transaction, hopefully it's a reasonably priced transaction and we can generate a reasonable return. So you can seller's perspective, from the general partner's perspective, and from the buyers.
Okay, and I wanted to take your last comment, talking about these win-win situations, but also reasonably priced transactions, because I guess that right now we're starting to see the light at the end of the tunnel in terms of the pandemic. But if we go back last year, where we're going through such uncertain times, you saw a drop in the volume of transactions, because I guess a secondary buyer might be asking for a big discount, given that you didn't know what will happen the next month and not even the next week. But you, as a limited partner selling your position into the fund, might say, selling at a X discount, maybe get something smaller going forward. So if you can comment a little bit more on that, and also for you, Renato, and your experience, what did you see, especially last year, as I said?
Yeah, you're absolutely right. That's exactly what happened last year. So the traditional part of the business, the selling of limited partnership interest, went down. And then the GP-led transactions went up. So on the traditional LP side, what happened was you had a lot of limited partners that wanted to sell, but because of all the uncertainty in the marketplace, they were concerned about potentially having to sell at a discount. And from a buyer's perspective, right, we're looking at these assets, right? We're looking at a limited partnership interest in a private equity fund that owns portfolio companies, and you're trying to assess and handicap how are those companies getting impacted by COVID, right? You have, obviously hotels, airlines, those are easy, restaurants, but how about a roll-up of dental offices? When will people start going back to the dentist? And that's really hard. We still don't know the answer to those questions. Those are really hard to underwrite, those risks. And so what happens as a buyer is you get a little spooked and you put a discount on the value of those assets because of that increased risk. And so you've got a seller that maybe doesn't want to take a discount because a quarter earlier, they were getting a very good price. You've got buyers, on the other hand, that need a big discount because of the increased uncertainty, and there's a bid-ask spread there, and that results in a reduction in transaction volume. And that's what happened on the traditional LP side. Again, on the GP-led side, it actually increased significantly.
These GP-led transactions, which seem to be the most active sector last year through the pandemic. In general, on the GP-led transactions, but also on how did you mitigate any potential conflicts of interest in that type of deals?
Yeah, no, it's a good question, and it's critical when you evaluate any sort of GP-led deals. Ways to mitigate transparency, right? So when GPs initiate a process to provide liquidity, fund level liquidity for their LPs, the process should be efficient and transparent. And then you have the LP alignment, which is also critical. So the GPs must engage LPs as early as possible in the process to provide the rationale for the restructuring and any alternatives considered. And also the GP should allow for sufficient time to fully consider the terms and evaluate their proposed transaction, especially the differences between the different funds. And well, and this has to do with disclosure, actually, which is also like the third point that I want to make. The GPs should endeavor to achieve a parity of information, meaning the same information that they provided to secondary buyers, such as us here in this call, should also be provided to their LP base through a data room, for example, or a confidential information package. But the LPs should have, feel comfortable enough that they have the same information and sufficient time to make a decision. Time, typically, it's around the portfolio companies, but also on the vehicles, and the LPs have to have very clearly what are the main differences in terms, economics and other considerations regarding the vehicle that they are currently invested and the continuation vehicle. So when you have a fully transparent and efficient process, you can really mitigate potential conflicts of interest.
Okay, thank you so much, Renato. So now, when you think about key qualifiers or maybe key aspects in evaluating a secondary transaction, particularly right now, I mean, what are you looking for? And as I was asking at the beginning, if any of those aspects changed as a result of the current pandemic?
Yeah, so look, I think one of the beauties of the secondary market is that there are multiple strategies and multiple ways to generate returns for investors. It's one of the fascinating ways the market has evolved over the last 20 years. And so I think you'd get some nuanced responses depending on who you ask that question and what their strategy is and how they generate returns for their limited partners. But as a general rule, if you boil down secondary transactions into their most basic moving parts, you really have three components. You have asset quality, you have sponsor quality, and then you have the deal dynamics. And I would say in any transaction, we're looking at those three factors and trying to assess the relative attractiveness of those elements in any given deal against all of the other deals in our pipeline. And with approaching $100 billion a year in industry volume, one of the luxuries that we all have is we very meaningful pools of capital. There are lots of transactions out there from which we can select. So HarbourVest tends to be more oriented at higher quality assets, which means in general we're probably paying higher prices relative to the deeper discounts you may be able to get for more distressed or more risky assets, but that's a strategy that's served us well over time. And the same goes for sponsor quality. We are much more interested in partnering with the top tier sponsors that we side in our co-investment business. But to the extent that there are groups that partner with general partners who maybe have less experience or less proven, again, you may be able to acquire those assets at lower prices. So it depends on what you prioritize and what you value within your strategy in particular, and then being able to repeat the success that comes with that approach. In terms of what's changed for us, again, it's really been around industry exposure. And Rudy acknowledged it that while we have more visibility now than we did, say, in April of 2020, there's still some uncertainty with respect to certain industries. And I think that the industries that we have been more focused on are those where there are higher levels of recurring revenue, more visibility on future revenue growth, and just in general, more stability and more diversification within customer investing the future, which is really what each of us are doing when we're investing into a secondary position. And I think that translates into having higher levels of conviction around what those underlying portfolio companies will ultimately do when it comes time to exit, whether that's through an IPO, a trade sale, or another GP-led transaction. So those are many of the ways in which we orient our thinking when it comes to screening opportunities and ultimately deciding where to focus.
And Derek, if I may ask you, as you alluded at the beginning, you're much more focused on smaller mid-market transactions. Would you say that there are any differences, or in your particular case, if anything has changed nowadays compared to what you were doing and how you were doing it prior to COVID-19?
Yeah, I mean, I think it dovetails a little bit with what Jeff was talking about in quality and experience of the GP. I think certainly if you look at lower market sponsors, generally speaking, they aspire to be large market sponsors, so they grow. So you're taking on oftentimes a little bit less proven of managers and often a little bit less experienced too. So you have to be able to roll up your sleeves, so to speak, in English, and really understand sort of the situation you're getting into. That said, there are a whole host of I guess I'd call it funds below 1 billion in total capital size that are really high quality sponsors that would like to stay at that end of the market. And generally, that's where we target most of our time in lower market secondaries, particularly on the GP-led side. And as I said at the outset, I think these transactions are quite pervasive among the large sponsors, and we're now getting to the stage where we've probably seen at least a handful of sponsors maybe taking on their third GP-led transaction at this point. This is, so people talk about this sometimes in the secondary space as technology, which sounds kind of crazy. And I think it's really, it's not rocket science what we're doing here. It's rather quite basic. But this notion of doing GP-led deals as we're meeting and tracking GPs for our portfolio, oftentimes it's a new concept to them. So there's really an education process that we have to go through with sponsors that have a little bit less experience. But like I said, I think that this is a growing trend that's going to continue to grow at the large end of the market, and it's just beginning to take off at the lower end of the market as well.
Okay, thank you so much, Derek. So now, Rudy, I wanted to ask you, what would you recommend for those GPs that are currently looking for either a fund extension and or additional capital for their portfolio companies? And I ask you because probably as a result of COVID-19, those companies that might or should have been sold last year might be sold, let's say, in 1 or 2 more years. So again, what would be the recommendation, or if you have done it before with other managers, what would you tell them right now?
Yeah. So I think the liquidity issue that you're touching on, which is creating the question, I think is spot on. So and just to touch on that first, what COVID has done is created liquidity issues at portfolio companies. So the underlying portfolio companies, where they thought they were well capitalized, where they thought they weren't breaching a covenant, where they thought maybe there would be a liquidity event that was early, as you're correctly pointing out, Francisco. All of a sudden, that's dissipated and it's dematerialized. It's not happening. And these underlying portfolio companies, because of COVID and the operating impact on these companies, have created a liquidity issue for them. And there's a few things that general partners can do. So if a general partner, for example, has a company that's got, and maybe I'll just use my dentist roll-up strategy example. So you've got a roll-up of dental practices in the U.S., for example, that we've seen recently. Now, we don't know when people are going to start going back to the dentist the way they were going back to the dentist. So this dental roll-up, this compilation of all these dental practices now needs liquidity because they still pay their dentists. They still have to pay rent, but they don't have the cash flow. So what does the general partner do? Well, there's a few things they can do. First, they can just sell the company. And we've seen that happen where a number of general partners have actually done that. They've sold the company prematurely. They're going to get a COVID impacted price. And that may not be the best thing for them. General partners have also brought in secondary groups like ourselves, where they might sell, let's say, the company into, instead of selling the company into a competitor, they'll sell that company into an affiliated SPV or special purpose vehicle. So what they're doing is they're taking that company, which is going through a short-term operating issue, selling it to an affiliated vehicle that we acquire and we basically buy that asset from them. The general partner now, instead of selling that asset to a third party, one of their competitors, continues to manage that company. And the existing LPs, and this is where it becomes interesting, because yes, it generates liquidity for those existing limited partners, but for those existing limited partners in that private equity fund that own that portfolio company, they have the option of rolling into that new vehicle or maintaining their exposure to that company. So and in addition to that, what we'll do is, and my colleagues on this call will do the same thing, what we would do is we would finance that company and provide additional capital. So to ensure that company is properly capitalized. So why does this make sense, this transaction? Well, first, from the company perspective, you had a company that was running out of money, might be breaching a covenant on their debt, maybe on the verge of bankruptcy. Now you're able to basically sell it into an entity which better capitalizes the company with more cash. So it's good from the company's perspective. It's good from the general partner's perspective because they've taken a company that they manage in one fund and are managing it in a different fund, in a new special purpose vehicle, but they continue to manage that asset and they can get economics on that. But it's good for the limited partners also, because those limited partners can choose to either take the liquidity from the sale of that interest when we buy it, or they can invest alongside us in the company. So if a limited partner says, I don't like the price that this general partner is selling this asset at, it's COVID impacted. This company is going to come back in 9 months and the valuation is going to go up. Well, what they can do is roll over into the new vehicle and continue their exposure to that company. And that's a way for a general partner, to answer your question, to raise capital for a company that might otherwise have capital issues.
Thank you so much, Rudy. Very helpful. And actually, I just wanted to somehow connect this with, and this one might be for you, Renato, since you're based in the region, maybe closer to local LPs, is what would be the recommendation for LPs? Let's say if an LP wants to sell, and I ask you because based on my experience and what I guess is that very few local LPs have done a secondary transaction. A lot of them have invested in secondary funds, but not so many have actually sold positions into private equity funds. And whenever they have to face that situation or opportunity, basically they don't know where to start with. Who should they call? Who should they hire? So if you could comment on that. I don't know if you have gone through a transaction like that, but in general, what would be those recommendations?
Yeah, no, sure. Happy to discuss the recommendations for the LPs. I think just before I dive into the LPs, I just want to complement one recommendation that for the GPs actually on GP-led deals on restructuring specifically. I think of course the companies need to have high quality, as Rudy said. I mean, high quality portfolio companies. Any GP-led transaction, right? And GP alignment, I think one of the best ways to get a decent GP alignment is on GP commitment. So ideally, not only when there is a restructuring or continuation vehicle, the GP should roll over their existing commitment into that portfolio, that company, but ideally make also an additional commitment. For us as secondary buyers, it gives us a lot of comfort to the quality of the portfolio companies when the sponsor managing these assets have skin in the game as well and are excited to increase their ownership on that portfolio companies as well. Now, moving on to the LPs, I mean, now as you can see, I think the secondary market has developed a lot over the last years. In 2019 was an almost $90 billion market. Last year with COVID, was around 60 billion, but the second semester was basically in line with the previous year. So there is some liquidity already. I can say that if a certain LP has a portfolio of good, huge, issue in attracting interest for that portfolio. There are ways. I think it's also always important to have very clearly what they have in mind with the secondary process, meaning if the priority is to maximize price, there are ways to maximize price. For example, you can select a subset of higher quality funds within that portfolio, which naturally carries. Another way to do it, for example, is to consider, when possible, a deferral consideration. So when there is a deferral consideration potential, when the LP doesn't need to sell for immediate liquidity needs, it's more of a portfolio management exercise. A deferral consideration can help maximize price as well. So these are some of the examples that you can use to maximize what the seller is looking for. If the need is simply to get short-term liquidity, then again, I think you have to think about on your portfolio as a whole and see which funds you are more likely to sell, which GPs you're planning to maintain a relationship and continue making new commitments, which ones you don't or are less inclined to. And there are ways, again, to select a subset or maybe a partial sale of existing funds that can help you maximize your goals.
Okay, thank you so much, Renato. Now, I just wanted to make a quick poll with you guys. The first one would be if anybody has acquired LP positions in Latin American GPs recently, and by recently, what I mean just a couple of years, not just let's say last 12 months, but just to try to get a sense of how active you have been in the local market, and then on how much appetite you can expect from international secondary managers in Latin American GPs. So just for the sake of everybody being able to see and hear you, I'll go probably one by one and you can quickly tell us. So first, Derek, have you had any experience?
We have, given our office in the region and our focus as well, we have a number of strong primary relationships. We've done secondaries and co-invest in Latin America in the last couple of years, and we'll continue to look to do that on a go-forward basis. We've not done a GP-led in LATAM yet. I know there have been a handful of them. I think there are a handful more coming. It comes down to quality of assets, quality of manager question that I think Jeff raised. But I think there's only a matter of time before we do one of those deals, and certainly I'm sure people attending the conference are planning the next transactions that we'll all see in the coming months. So,
excellent, thank you, Renato. Your case.
Yeah, we have. So as I said, we also have 2 offices in the region: one in Santiago, one in São Paulo now, with locally staffed investment team. We have been active in the region. We acquired both secondary stakes of Latin American GPs, both as part of a broader diversified portfolio, but as well as a single fund. And look, we've done both primaries and secondaries. We haven't done a co-investment yet, but we do have a dedicated co-investment fund and could look to do secondary co-investment deals in the region as well.
Thank you, Renato. Rudy?
Yeah, I mean, we've been in the region for a long time. So we've done primaries, a lot of primaries. We've done a number of co-invest, and we've also done secondaries. So we like to think we're pretty active in the region.
Excellent. And Jeff?
Very similar to Rudy. We've been in Bogota for over 10 years now, and so have been active on the primary, secondary, and co-investment side, both in the form of global diversified portfolios that we've acquired, as well as more targeted purchases of specific funds by local general partners.
And Jeff, I wanted to ask you, going back to my question to Renato in terms of recommendations to local LPs. I don't want to go into too much detail, but most of them will typically invest in local managers which have local structures. It could be a Colombian fund, or if they're investing in foreign managers, they'll probably go into what we call an offshore vehicle that could be Cayman or some other jurisdiction. So for those that are thinking about selling their positions in those managers partnerships, would you say that that's a challenge for them? It's a plus minus, or at the end of the day, it doesn't make a difference really in terms of the pricing and willingness of a secondary manager to make a transaction?
Yeah, so look, what I would say is for any seller of LP positions or private market assets, the best buyers are buyers who know those assets well already. I think any buyer who comes at an investment opportunity from a standing start without having any insights or familiarity with the assets that are available for purchase, there's more time required for that. So I would say one of the best first places to look is to your left and to your right to see, are there any other LPs in the fund who are either secondary players or have the ability to transact on a secondary basis, who might be able to benefit from that existing knowledge. It's not to say that you would have to rule out someone that's not familiar with the fund, but that's often a good first place to start. Beyond that, any dedicated secondary buyer the best pieces of advice is for sellers is to try and have a sense as to what your reservation price would be for those assets, and to have an understanding as to what tolerance you might have for accepting a sale price that could be below net asset value, particularly if it is a lesser well-known or smaller asset that might have less familiarity in the secondary market, and where that lack of familiarity could translate into a bigger price on the part of a buyer. And then the last thing I would say is it will take longer than you think. I think first-time sellers in particular are always a little bit surprised with how long and how intensive the labor can be in divesting in an asset. And I think that just speaks to the benefit of working with buyers that do have experience and can really drive the process to try and hopefully make life easier for those institutions that may be considering selling.
Thank you so much, Jeff. And maybe Rudy, you were talking about this, and to complement what Jeff just said, what would you say is the time for a traditional secondary transaction to be completed, starting on the day that you reach out to the GP till you actually sign and close the transaction?
Yeah. So in terms of process and in terms of time, the first, once a limited partner reaches out to sellers, to buyers. So when a limited partner decides they want to sell a portfolio or a limited partnership interest, they'll do that either through an intermediary. Now today it's almost always intermediated, or they'll directly call buyers. And, from that conversation, what we will do is, it's true for others on this call also, they have exposure to these general partners and these funds and maybe the underlying assets. So we'll call up the general partner, try to get an update on the assets, look at the financial statements, try to come up with pricing. Now that doesn't take that long. With a general partner, it could take, let's say 2 weeks, maybe even less, frankly, to come up with some indicative pricing, high level. And typically that would be a range. And if the range is acceptable, you keep working. And then you do confirmatory due diligence, and that would take another couple weeks. At that point, if everybody's agreed on the price and the terms, maybe there's a deferral. an earnouts, whatever it is, once everyone's agreed on the terms, where, as Jeff said, you could get hung up. Because oftentimes if you have, a first-time seller, these are new documents for them. Their law firm may or may not have worked on these transactions before, and there's a lot of back and forth in these transactions, and that could take, up to 3-4 weeks at that point. And then you've got to potentially transfer the assets. So you might be able to sign a deal, but there may be, for a variety of reasons, a period of time between signing the transaction and actually closing or transferring the interest and cash being exchanged. And that could take, depending on what the underlying documents say for the partnership, that could take another couple months.
Okay, well, thank you so much, Rudy. So gentlemen, thank you so much. We ran out of time. So I just wanted to thank each one of you. Thank you to everybody. I know it's weird to have a virtual Congress. So hopefully next time around, we can all be sitting here in Bogota with lots of hugs and kisses. But in the meantime, just stay safe. And I'll open it up if any one of you would like to make any final remarks, or we can just wrap it up.
I'd just like to thank our moderator for doing a fantastic job. Gracias, Francisco.
Thank you, Jeff.
Right. Thank you, Francisco, and thank you, ColCapital, for the opportunity.
Yep, I agree. Thanks, everyone.
Thank you, everyone. It's been great.
Bye-bye.
Bye-bye.
All right.